We now examine several different dividend discount models. We'll start with Gordon's single growth model. The model basically assumes dividends grow at a constant rate. They're annually paid. We're standing at a dividend payment date, and so the next dividend is 1 year away. It'll grow at a certain amount, and there's some risk-adjusted discount rate. You could think of this in a capital asset pricing model framework. You could have some sort of risk premium tied to excess returns in the market over the risk-free rate, and you can have some estimate of the dividend growth rate. It's very simple but crude. It is a constant risk-adjusted discount rate and a constant growth rate internally coherent? Does it correspond with empirical observations? These are some of the challenges in using this particular model. So if we want to improve this model, there's a couple things we could do. One, we should incorporate quarterly dividends, but allow the dividend to change only once per year. That's generally the way that dividends in the United States are handled. And so I'm going to assume a constant growth rate within each stage, and I'm going to assume a constant discount rate within each stage. And there's going to be some stub or initial year that has H remaining dividends. And so it could be the last constant dividend for the year has been paid, and there's no dividends left. And so in that case, there would be 4 for the next period, and we would start with it growing at some growth rate. And so the way we're going to model this would be the discounting of the stub period. If there's, say, 2 or 3 or 4 remaining dividend payments, or even 1. We're going to rely heavily on an infinite series result and a finite series result to get the math to work. If you're interested in the details, it's provided in the materials. And basically, this valuation approach is going to have 3 components. There'll be the initial stub period until the next increase in dividends. There's going to be however many growth stages there are, and then there'll be a final stage where we'll have a perpetual model. And so the math is going to work out. This is the stub period. Each series is going to be equal to this expression, where this is the forward rate applied during the period, and it'll be discounted back using this product of the forward rates and growth rates in prior periods. And then we'll have the final infinite series payout. And again, you can check the math in the materials, but the goal here is to move from an oversimplified constant dividend growth model to a more realistic quarterly pay, allow for different discount rates for each stage. You can just assume they're all the same if you wish, and proceed to model it this way. So if we assume 0 growth, and there's basically only one stage, we could compute the present value of the dividends, or the value of the stock in this case is $40.09. And so basically we assume a stub period, and that same dividend is applied for the remainder of the infinite series. If we assume one stage with growth, a one-stage model with a 12% growth rate, the model is basically you have the stub period to address, and then you have the dividends growing at that single stage for a perpetual period, and this would be a $57.70. A 2-stage model is just a matter of having two intermediate stages. This is the stub period, this is the first stage, and then this would be the perpetual stage. And so it's a 3-stage model. Rather than writing it all out, the software, the R code, produces the valuation, assuming these forward rates over the different stages, the growth rates over the first, second, and third stages, and how many years each stage has. Remember, the last stage is perpetual. And so we can go to a 4-stage model, and can look at a variety of different results that come out of that. And so the dividend file there's a file that's produced that maps out the dividends. And so what you'll notice is that the dividends are increasing, the present value factor is decreasing, and therefore the present value of dividends factor is also decreasing. Again, we can map these results out. You get this jagged line early because of the growth rate is dominating the discount rate, but after time, it's the discount factor that is having the biggest influence, and you no longer see those spiked edges. If we wanted to apply the LSC model, what we conclude to fit the present value curve is that a four-factor model fits very well, and you can't really distinguish between the two. So going forward, if I'm trying to model the risk related to this particular stock, I can use a simple four-stage model, or even a two-stage model if it's adequate for the objectives that we have at hand. An alternative, we're going to seek to apply the LSC model framework to equity market data only. That is, we're going to look at different sectors, and we're going to base this solely on available equity-based information. And again, we're seeking an alternative valuation framework. The details are explained in the text that's provided, but just to briefly go through this, you have the forward discount rates and the growth rates are assumed to be continuous in this case, as opposed to different stages. And so we have a growth curve and we have a forward rate discount curve. And so if we assume a two-factor model, we have growth. There's a perpetual growth rate. There's the scalar that's adjusted, and there's a slope of the growth rate. We have the same concept for forward discount rates. If we apply scalars to both the growth rate and the forward rate, which could be different, we come up with a valuation model that looks something like this. And then the value per unit of an initial cash flow, if I divide by the initial cash flow, this is per dollar cash flow, which will be useful. At some distant point in the future, we would expect that the value of these cash flows simply to be the difference in the perpetual forward rate and the perpetual growth rate. The closed form equivalent of that can be represented this way. If we solve for the long run forward rate, we can actually infer a long run forward rate with this expression. And so if we assume a long-term growth rate is proxied by the long-term interest rate, for example, LIBOR or now SOFR, the secured overnight financing rate, or some other, say, the 30-year treasury, we could apply a dampener to the account for the lack of complete adjustment. Some industries might not adjust completely. Again, we have four critical values in developing our model. So the first stage is we want to estimate the slope of the growth curve. The long-run growth rate assumed to be based on to be some base curve level parameter. In the limit, this is operating from insight from Professor Damodaran at NYU. In the long run, you'd expect the growth rate to asymptotically go to some perpetual interest rate, given the overall cost of equity and the cash flow yields, assuming we have some sort of estimate of a constant discount rate, we can come up with a valuation. And so to illustrate, we basically can solve for the growth rate of SPY, in this case, using market parameters observed at this time, to get a slope of 9.6%. And so basically, we've now come up with a very unique way to map out growth rates for SPY. Now we want to estimate the level of the forward curve. Again, based on the dampener and the average of the cash flows, we could estimate the level forward curve in this manner. If we apply the parameters that we've estimated thus far, we can come up with an estimate of that particular parameter. Solving for the slope of the forward curve, in this particular case, we would come up with minus 2.38%. And basically, if you, without going into a whole lot of detail in this presentation, we can solve for the four parameters, level and slope of both growth and the discount rate. And we have a fully specified model of something like SPY. And so we can appraise this. We can look at basically the different sectors in SPY. We can observe the market price. We can pull the dividend yields. We can look at the appropriate discount rate based on some independent estimate or beta or some means of getting a sector discount rate. Using the two-factor valuations, I'm going to assume the scalar of, I'm going to assume a two-factor model, scalar of 3.0 for growth and 10.0 for the forward curve, and then long-term growth of 4%, and the dampener is 50%. And with that, we can come up with a whole suite of growth rates based on the LSC model, as well as forward rates based on the LSC model. This is particularly useful in trying to understand the stochastic behavior of different sectors of equities across time and how these things change. Will give insights into the risk and expected returns of different sectors. And so the particular R code generates an enormous amount of output where you can do this sort of analysis and appraisal of the different factors related to this model. So an alternative LSC approach, there's three key curves. There's the base curve, say U.S. Treasury. There's a credit spread that we saw with corporate bonds, double B minus Treasury. And then we could look at the spread over the double B rate, which is equity market based. And so basically we have the base curve, we have the credit spread, and then we have the net of the equity risk premium and the growth rate. And so we're going to explore the implied growth parameters with this model. And so in summary, we've examined the dividend discount model in a variety of different forms. We took a brief tour through the stock market returns and noted that every decade you're typically up significantly, but there's at least one downdraft that's also significant. And so if you're going to be an equity investor, you need to prepare yourself for seasons when your portfolio is down a sizable amount. The key is to be a long-run investor. We explored the end-stage dividend discount model. This is a very straightforward, a reasonable adjustment if you're going to be relying on models of this nature to incorporate the quarterly pay nature, as well as be able to apply different stages. Alternatively, rather than using stages, we could apply the LSC model and allow for a growth curve and a forward curve. And in those two curves, we then build out a very parsimonious model of for the dividend discount model.